Hi, very good evening, everyone. Welcome once again for this exclusive webinar session conducted by Bajaj Finance Limited for all our wealth customers and our team members so as to get information about what's happening in the market, how the global scenarios is moving, and what should you do with your investments, and for so as to have that kind of understanding of the market scenarios. We have Mr. Pratik Agarwal with us from Motilal Oswal Asset Management. Mr. Agarwal is Executive Director, Business and Investment Strategy. He has over a rich experience of 28 years in fund management and equity research. He has already worked with ASK Investment Managers as Business Head and Chief Investment Officer. He has worked with BOI EXA Mutual Fund and BNP Paribas as Head of Equity and Head of Research at SBI Capital Markets. Mr. Pratik is Bachelor of Engineer from NIT Rourkela and PGDM in Finance and Marketing from XIM Bhubaneswar. Without taking much time, I would request our esteemed speaker, Mr. Agarwal, to share his thoughts on the market outlook and the way forward, which will definitely help our viewers to make some better investment decisions about their own portfolios. Thank you so much, and over to you, Mr. Agarwal.
Thank you, Mohit. Uh, how do I again get the PPT? PPT is gone.
Yeah, it is there, sir. It is there. We are coming. Yeah.
Okay. Thank you. Such a relief.
Yeah, sir,
Okay.
please.
Hi, everybody. Let me start with the topic of the day, which is our outlook on the equity markets, and then we will talk briefly about how are we useful to the end investor. Uh, Let me. एक minute go. Yeah. Uh, so, in the marketplace, there are two styles of investing. One is the value style, the other is the high quality, high growth style. In value style, you seek to make most of your monies from buying something which is worth 100 bucks at deep discount to it, say 50, 60 bucks, and would want to sell it once that journey is bridged. From 50, if the stock moves to say 70, 80, you would probably leave something on the table for the next guy and want to move out, depending, of course, on the size of the fund and the investment. Now, growth style is where, yes, there can be some amount of discount to value, but you seek to make more money from compounding of a business. So 100 rupee EPS becomes 120, becomes 140, becomes 160 over a period of time. The value of the business keeps expanding. You keep holding the business, and marketplace will value it appropriately at some point in time. Now, at different times in the year, different kind of styles work. Different periods over last 10, 12 years. Mohit, can you hear me? Yeah. Let me take you through the journey. The different styles work. Now, money is a factor of production. Let us
Mhm,
first hold money. Uh, if you come from 2012 to 2020 and you want to access more money, you were hit with headwinds. So, for example, in 2013, we experienced the taper tantrums in the West. Any company which had borrowed large amounts in FCCB is today a shadow of former self. Any construction company which had borrowed abroad in that period is now a shadow of former self. So that is one example.
mhm,
Then come to 2015, under the earlier RBI governor, we started to recognize banking sector NPAs. We did it in a manner that lending became a bad word and borrowing became a dreaded word. So neither were lenders lending nor was borrower borrowing, and uh, that meant that companies which needed money to grow, for whom money was a large requirement,
mhm,
ceded market share to businesses which did not need money to grow. which had cash on book, where the business was generating enough money from business itself, so high ROCs businesses.
mm,
So this was the phase where, since people who needed money from outside to establish businesses and grow, did got less of it. By the flip side, the higher quality part of the market got had a competitive advantage. Let me put it
mm.
that way. And well, markets follow earnings. This was the part which delivered relatively better earnings, and this performed.
Okay.
So this is one context. Okay, and it culminated in a ILFS kind of crisis in 2018. So from
Yeah.
2012 to 2018, that is what happened. In between, in brief periods, the other style tried to make a comeback. For example, in 17, but the ILFS thing in 18 quickly doused that. Now take another thread, okay, which is disruptions.
Mm,
Now, if you once again come from 12 to 20, look at the kind of disruptions we had. Demon in 16, ILFS itself was a disruption. You got RERA and GST, both structural reforms but disruptive. And then ultimately you got a COVID. So whenever there is a disruption, it is the larger companies which stand out better versus the not so large companies. And in this period, the big theme was smaller to larger, and within organized sector also, from smaller organized to larger organized.
mm,
Okay, and if you remember the newspaper headlines in that period, it used to say, well, index is working, but the broad market is not. My portfolio is not speaking the same language.
mm,
Okay, and third, in this period, if you look at the color of the money, it came from FPIs. Now, FPIs, while we celebrate and it is a net inflow into the country, FPI
mm,
money is close to the index money. It is not alpha
mm.
seeking, it is beta seeking money. And the Indian money was mostly insurance money, which came in the Jan to March quarter, again close to the index kind of positioning.
Okay.
So in this period, either the large did well or high quality did well. Okay, so now let's move to 20 to 22 kind of a period. In this period, the slide is already on. What we have seen is different kind of reforms. COVID happened. The world
Mm,
started to look beyond China. If earlier globalization was the buzzword and
mm,
import duties across the world were coming down, now post COVID, during COVID, the world recognized that they need to have some amount of manufacturing within the country. America had this thought of making America great again. We always wanted to do it, make India great. We could raise import duty protection for Indian businesses. So you see the change, it is very stark. Second, you could roll out PLI schemes for space after space. You could have Make in India as a policy. We rolled out defense indigenization, green fuels, etc., etc. So
mm,
versus the disruptive reforms you were getting earlier, now what you are getting is a slew of very, very supportive reforms, and no wonder corporate India is cheering. It shows in numbers. If you look at numbers as they come up from COVID, yeah, this slide, look
mm,
at the bottom chart, one from 12 to
mm,
20. If you see, the CAGR growth in earnings is simply not there. 14 to 20, Indian Nifty had the same earnings, in 400s. The total growth was just about 15-16%.
mm,
Total CAGR, total. Now, that changed from COVID base actually of 2021. Look at how the larger caps have done. Broke through the 400 glass ceiling in that year.
mm,
But in 21, look at mid cap. They still were declining. In 22, this part moved up very sharply. to 410. So first year of disruption, the larger ones did relatively better. Second year is when mids did well,
mm,
supported by a slew of policy reform, supported by import duty protection and so on, and a broadening market.
mm,
This was a space, this was a part 20 to 22 when markets were moving up from COVID lows. Growth was omnipresent because the base was so low.
mm,
If I draw your attention to, let's say, banking in the last quarter or the last year, practically all banks delivered very strong growth.
mm,
In AUM as well. Let me change these slides. Don't move these slides, please. Uh, and the gap between the corporate banks versus the others were smaller. Uh, so obviously, investors chose lower price to book banks over higher price to book banks because growth was omnipresent. Okay,
mm,
so we what I've tried to do is to make you understand why high quality, high growth, maybe larger size, maybe index did well in the 12 to 20 period. I've tried to explain to you 20 to 22 kind of a period where there was a reflation and the value style came to the fore. Because in this period growth was omnipresent, the high quality, high growth style was very, very expensive, and this is the part which
mm,
caught up. Now, where are we? We are at a junction as we speak when growth is expected to fall sharply from a 15% nominal to a 10.5% nominal. Okay, your budgetary numbers is 10.5% nominal. Now, that means that as we go deeper into the year, growth which was omnipresent will start to get at a premium.
true.
Okay, is one thought. So while there is nothing to say that value style will go out of flavor.
Mm,
Maybe not most. If you look at a period prior to 2012, well, both styles were competitive. Some worked in one period, other worked in some other period, but over a period of a year both styles would be competitive. But last 12 years were very different, and I boxed it into two parts. Now this year, while there is nothing against value, just now there is no disruption happening in that part of the market,
mm,
but there are things turning for the positive for the high quality growth part of the market. One is now it is growth is no longer omnipresent. It is going to be more difficult to get growth. So
mm,
people who are able to deliver similar to last year growth should do much better in the marketplace. And second is that in this year, as we go deeper, maybe September, maybe October, one should expect to see the first sense of rate declines
mm,
in India and globe. So last quarter of this calendar year is when that is expected. Once again, lower interest rates or toggling over of the interest rates is a great signal for performance of the higher growth space, because there the terminal values are higher versus the lower growth spaces. So that again is a tailwind that one should hope to encounter.
mm,
So that is my sense on the market. Few things that I want to show you. One, well, US, you have seen a lot of banks go under, and recently enough, there was a scare what would happen to India. Well, on this chart, if you see today, if the yields are here, can you see the cursor?
yeah, sir, it's quite visible.
Now, for this, the even after the decline, the current yields are higher than anything that was there in the US for last 10 years, which means 100% of the paper issued by the Fed over last 10 years is at a loss.
Mm,
Okay, compare that with India. This is where we are. Except for this space and maybe some part of this space, everything else that was issued by
mm,
RBI over last 10 years is at a profit. So, 30-35% of the paper may be loss making, rest of it is profit. So, what has happened in the US probably doesn't happen here. Here, people are still sitting on some amount of treasury gains. The other thing is what is happening to Pakistan, Bangladesh, Sri Lanka, and many other countries globally where markets are in turmoil. Can it happen in India? I think our big differentiator over those countries is the strong forex reserves that we have. This is something which I keep saying is the fort against the tranquility that you see in India versus the turmoil that you see beyond our shores. So you saw RBI increase interest rates when we were losing forex reserves in this part. Okay, once forex reserves increased, RBI stopped increasing rates.
Hmm.
So forex reserves is super important. Pakistan, Sri Lanka, Bangladesh are not able to do business because of 1 2 month of forex. Our forex reserves are very strong. If you look at number of years of current account deficit that they can fund, it is in the vicinity of 6 years. Now, current account deficit itself is getting better. If you look at the latest trade data, our monthly trade data has declined, the deficits have declined sharply, which means that on the forex side, we are very sustainable. Uh, the other point that people talk about and is there all over in the media, global slowdown, तो हमारा क्या होगा? कुछ नहीं होगा. Global, our exports are 18% of our economy. What is the extent of global slowdown? People are expecting 1%, right? Any which ways, globe doesn't grow faster than 3.5. If it
Hmm.
grows at 2.5, is a 1% slower. 1% slower probably shaves off 18 pips, 18 bips, 0.18% of our growth, which we will have to make up from other spaces. Now, my thought also is that today, since globe is slowing down, we are getting a lower price of oil. If growth in the globe was faster, oil price would not be in the 75 region; it would be higher. Now, that brings me to the next thought. Lower commodity prices improve India outlook tremendously. India is a net importer of commodities. India imports oil, the second largest importing country after China, and as a percentage of GDP, probably the highest amongst the larger names, larger GDPs. And hence, when somebody is trying to allocate monies globally, a period of lower oil prices is good for Indian markets and vice versa. I don't have that chart, but if you map the lows of Indian markets in the recent past, it coincided with the highest price. So when oil was 130, our markets were lowest. It fell, our markets rose. It rose again, our markets fell again. So watch forex, watch oil. So that is the two risk factors.
Hmm.
So, and where are the valuations? Well, two things. One, index versus itself is fine. So, if you look at the, I don't know what has happened here. Red line is the Nifty PE. My
Mhm.
construct of Nifty PE is 18 to 18 and a half times 1 year forward. 1 year forward EPS is 950 to 1,000 range. FY24, 18 and a half times bring us to where we are in the market. So I say come very sustainable. The other thing that is nice is earnings yield to bond yield indicator. Now, what was earlier in favor of bonds, this is slightly older, is now getting more even now actually in favor of equities.
Hmm.
Because bond yields have again fallen to 7%, and equity yield to bond yield indicator points to relative attractiveness of equities, even on a pre tax basis. Now, April onward, you got taxation changes. Debt, even through insurance, has become very expensive on taxes, so equities have become relatively much better. So, for a HNI investor, now equity is a very compelling case. So that is the thought. Now, what are we doing in it? Uh, Let me come down to one slide. So, what we have done as a team is to sit together and find out narrow themes, which I was talking about, to deliver growth uh, as we go forward, even in not so great times for growth. So, for example, across our funds, any mutual fund that you take, any alternate fund, PMS, AIF that you take, you will find this. So, Make in India, defense indigenization is a great theme. We are very, very clued there. So, engineering is something you will find represented in our funds. Stuff like ABB, Siemens, Cummins, BEL for defense, Bharat Forge is what we have in our various funds on this theme. Now, certain funds, especially the mid cap part, especially the founders portfolio may end up getting exposure here through cable companies such as Polycap, such as KEI maybe, and other cable companies. Now, the other space that we really like, and these are super narrow themes, huh, and you can develop this. Defense
Yeah.
BEL, I said, we also have an HEL, we have a Garden Reach as a shipyard
Hmm.
in various funds, 3 to 5% kind of exposure.
Okay.
Now, second, in healthcare, instead of saying generic, branded generic, etc., what we have agreed for our house is hospitals take primacy. Hospitals and pharmacy chains are at top. Branded specialty is next, followed by branded generics, followed by generic. In the end comes the bulk drug. So that is the pecking order. It is not like everywhere we give a 20p and whatever is lower we buy on a 2 year forward. Now, hospitals, if you look across our funds, barring two, would have exposure to hospitals like Medant, hospitals like Fortis, or a Max Healthcare is what we have in the fund house as spaces which can keep growing for longer. Now, third, in financials, which is a high growth space till now, we believe as we go forward, leadership will change. I made that case. So we are with financials, banks, where with NBFC DNA, stuff like IndusInd, stuff like Cholamandala, stuff like AO Finance, IDFC, maybe Kotak as well, where the growth DNA is more and where growth will sustain, even maybe IDFC, even when the economy slows down. So that is what I was
Hmm.
trying to talk about. And yes, insurance. So
Hmm.
insurance is something which, as a house, we have been very positive. It's not worked. If you look at our portfolios as a part of risk control, we have lowered our exposure, but we still stay positive. Life insurance has a presence. Health insurance is something that we have exposure through two names, Star and Religare, mostly Religare
Hmm.
in the house. China plus one we spoke of. Now it is increasingly becoming China minus one. We believe chemicals are a great way to play that. Every fund of ours would have some exposure, maybe PI, maybe Bayer in one fund, maybe Gujarat Fluoro, Archean Chemical, Deepak Nitrite, our names, SRF. So chemical names, so we have SRF, Naveen, and Gujarat Fluoro, maybe one bromine chemistry and one nitrogen name apart from PI and Bayer kind of names in this space, and clean science.
Hmm.
Autos and telecom are spaces where growth cannot be fast, but there was a margin increase story, so there was some exposure. But now, after the quarter numbers, when we saw margin increase and these stocks reacted positively, we paid down positions. Now, the next space, the new age tech, is a space where we have been quite positive. In all of my public this thing over last several months, we have been saying good businesses, good valuations, but yeah, ownership change will cause volatility. We are primarily there in two names, Zomato and Paytm. and to some extent even in Nika. Lastly, if you see urbanization as a theme, we are mostly through luxury retailing. That's a part where effect of slowdown should be felt at the end. So stuff like wedding clothing for Vedant, fashion stuff like premium shoes for Metro, uh, jewelry, so Titan kind of stuff, and maybe a mall that sells them like a Phoenix.
Mm.
So, I mean, we have other stuff, but this is where we believe, really speaking, growth sustains for longer, apart from fast fashion. So that kind of gives you, our themes where we believe growth will sustain for longer, and where we believe, as we go by, if nothing else, compounding in EPS, like I explained before, should result in stock price compounding. Our growth rates of our portfolios, if you see, are an order higher than the index itself, and post cost also we hence hope to make alpha for our investors. Very quickly, how are we different? We are great followers of QGLP framework. Quality, meaning ROICs, should be higher than the growth that we are seeking from the business. Growth in itself has two components: quantum, strong growth, and longevity of growth. So it is not 1 year growth that we are seeking; it is multi-year growth. And towards it, we shared with you the themes that we have developed, because they ensure longevity of growth. If a business makes 100 rupee EPS go to 200 in 1 year, and the year after it falls to, let's say, 80 kind of a level, versus another business which does 100 to 150 to 200 over 2 years, one can tell to oneself which one will you buy
Mm.
and hold for longer. So quantum is important, longevity is super important, and our themes try and ensure longevity of growth. And yes, valuations. So apart from our framework of ROE versus PEG on 2 year forward, we have also now got a DCF framework that we have rolled out. Now, the quality focused QGLP process, along with a very detailed risk framework, allows us to run very concentrated, high focus portfolios. So I don't know the listeners whether they are mutual fund type or alternates, but this is what we run across the house. The circles keep less than 5 names. Some sense, we are the only house which can demonstrate that. So you get high conviction portfolios across. Now, high conviction portfolios are premium portfolios. On the alternate side, the fees is 2.5 plus taxes. We sell the same thing on the mutual fund side at mutual fund rates. So that one big differentiator. And like I said before, there are two styles of investing: value and high quality, high growth. So we believe we have two unique differences. One, the high conviction portfolios, which as a rule we will continue to deliver with a lot of risk control, making sure that the riskiness associated with focus, with concentration, is not there, is less there, and being a very great exponent of high quality, high growth style, so that if you have us in the quality bucket and somebody else in the value bucket, your journeys are smooth. Now, on top of it, if you look at the mutual fund side, we provide you diversification benefit versus others as well. So our overlap, if you see, versus others, is very low, and that kind of points to a fact that when we will do well, others will not, and vice versa. and that is what I think makes us so very useful for distribution and for clients connect. Put us as a part of your portfolio, your ride becomes smoother. And as of now, performance is on our side. We have put in place a lot of processes. This is a house which is very, very strong on ideation. And if listeners look at our mutual fund, look at our alternates, they will themselves see a very strong turnaround over the past 6 7 months. Today, all 4 out of 5 of our equity mutual funds delivered alpha in financial 23, financial 24. 2 months have been nice to us. Uh, Three out of those 4 funds are ranked number 1, 2, and 4. On the alternate side, we have a founders doing well, we have a value doing well. BOP is the best performing fund in the industry over last 1 year. So that is our positioning in the client's portfolio. Segment the monies, one for value, the other for high quality, high growth. In the high quality, high growth space, I do hope that you guys allocate us a lot of money. We provide you focused portfolios and also diversification benefits. So let me stop here. Is there anything else that you want me to cover, Mohit?
Sure. Thank you so much, Mr. Agarwal, for sharing such a wonderful thoughts and the slides, which are quite relevant. Since we have already got some questions before we started this session, a lot of questions related to interest rate scenario of India, taxation part on the debt and its impact on the equity and debt. A lot of people wanted to understand what all the sectors to focus on, and I believe you have covered all three segments apart from the macro and micro level view of the Motilal AMC experts that what AMC thinks about. And secondly, about the investment philosophy of the Motilal AMC, which definitely helps investor to review their own portfolio, that what all sectors, what all investments they have done, what kind of view they have, and of course, it will definitely help them in short term and long term run. A couple of questions from the audience point of view, Mr. Agarwal, that since there is so much of volatility we have seen in the last couple of months, and after December, right now also we are approaching towards the all-time high markets. What is your suggestion for the new investors who are reluctant investing money in mutual funds for last couple of months, considering markets may go down and they were waiting for the money to invest? So, what will be your suggestions for the same?
No, so let me start by saying that we believe markets are valued fairly, which then means that the compounding in the market that you expect going forward is of the order of earnings growth, which should be somewhere around 12 to 14%, let's say 25 over 24. So as you go forward, you are starting to discount 25 earnings, right?
Yeah.
Now, if we break it up over a period of the year, what you will get is close to a percent a month kind of compounding.
Okay.
So, this is a year, this is a period. Whenever it happens, markets are no longer cheap; they're
Hmm.
fairly valued.
Hmm.
Whenever this happens, what you will get is a period of a lull. So, if I take two blocks of investors, FPIs and domestic money will keep coming in. FPIs will be volatile. When they sell, domestics buy, you get a -1,
Hmm.
-2% kind of a month.
Hmm.
When the FPI selling reduces, it gets closer to zero or +1 kind of a number.
Hmm.
But when both the investing blocks start to buy, you get a +7% kind of a month.
Hmm. Hmm.
Now, mind it, total returns for a year are 12 to 14%, logically speaking. And if from that a 7% goes, then, well, this is not a market where you can come in after you have seen performance. This
Hmm.
is a market where buy on dips is a great strategy.
Okay.
SIP is a great strategy. So position the monies. The downticks should not be large unless
Hmm.
something completely unforeseen happens.
Yeah.
And then, whenever the two large blocks of investors start to act in the same manner, you suddenly get a bump in that month. So it is that kind of a market. So I keep saying this: sips are good, dips are good.
Okay. So as to take care of the debts, I believe STP should be the right strategy for the people who are holding a good cash to invest in, waiting for that same money. So rather than
Yeah,
just keeping the
SIPs
money in
and
the pocket.
STPs are absolutely.
Yeah, yeah. Great, great. Any views for the first time investors are in this market? Those who have never invested in mutual funds and are looking for entry in the market. Uh, any suggestions or guidance from your side?
Uh, See, there are a few things that one should be aware about, one should see and notice. I think over the years, our markets have become way stronger
Hmm,
than the past. Regulations have been strong, focus on quality has come about.
hmm,
Uh, I think, and the outcomes have been good for small investors.
hmm,
So that is point one. Marketplace is now a much more closely regulated marketplace, which is great for smaller investors.
hmm,
To well, look at it this way: what do markets do? Markets reward people who are taking risk with their monies, building new businesses. As businesses scale up, that gets reflected in valuations.
hmm,
So over time, they should do better than debt. Is the other
hmm,
thing. So if you have long-term monies, 5 to 7 year kind of monies to spare, I think equity market experience should be good for investors.
hmm,
Third, I think India as a country is now in a great position
hmm.
versus earlier when we would hit one roadblock after the other with a
Yeah.
very high degree of frequency. So I keep saying this, country has a life similar to a human life.
Hmm,
When you are young, you get hit with more problems. You fall, you scratch, and you need care. We were a young country. We
hmm,
faced all of that. Now probably we are in our youth. 20, 30 years of youth are in front, where typically people get less sick. What used to bother you when you were small no longer bothers you.
hmm.
We are still some distance from becoming old like Japan, old like Europe, for
Right.
example. And hence, for long period investors into equity, this should prove to be a great time. Lastly, one thing that I will draw their attention is to look at, forget US. US mutual funds to GDP is a very large number. But
Hmm,
look at even countries like Thailand and Malaysia, where our kind of people live. You cross
hmm,
the border, people on that side is very very similar. They save, we save. Even what we go for is very very similar. Their mutual funds as a percentage of GDP is 2x, 3x of ours because their per capitas are 3x, 4x of
hmm.
ours. Now,
Yeah.
as India gets richer over the next 8, 10 years, same thing should be experienced here. Flows into the equity market should be strong and consistent,
Hmm,
something that we have been witnessing from COVID lows. As formalization increases, this is a further tailwind. I think if you position yourselves quickly with managers who are good, who to your mind are the best exponent of the value style, best exponent of the high quality, high growth style. I think
hmm.
while both may not function well at the same time, but your journey should be quite good as we go forward.
Certainly. And I believe, Mr. Agarwal, portfolio review requirement holds very true in such kind of scenarios where there is always a change of the business cycle. So, like as you have shared your thoughts about the equity, considering the longer outlook. So, most of the people ask me question that what should be the right time horizon till which we should be invested. So, friends, it is always advisable to be remain invested if you are looking for equity for at least 5 years, so that businesses should grow, business should be profitable, and that's how the funds will give you better performance. Of course, apart from that, there is a actual need of getting the regular financial review in place, just like you see a doctor as an annual health checkup. So don't forget your financial health, and you need to have that kind of financial review every year, so that you can make some wise decision by doing minor changes in the portfolio, or maybe top up your investments. As most of us were looking at such kind of campaigns, mutual fund sahi hai, where it is always said that yes, SIP top up should be there every year, so that it should help you to reach your goals in a minimum time. So with this, I would like to thanks all the viewers for spending our time and taking our time for this another awareness program which we manage with the Motilal AMC. And thank you, Mr. Agarwal and the team who took our time for our esteemed
Thanks.
customers and shared your views. I would like to have such kind of webinars in future also, considering the market outlook and new market scenarios on any opportunity which may be beneficial for our viewers. Thank you so much, and have a great day. Thank you so much, Mr. Agarwal.
Thank you. Thank you. Bye.